Welcome to WealthEchelon, your go-to destination for expert insights on finance, stocks, and ETFs. Our mission is to empower you with the knowledge and strategies needed to navigate the financial markets with confidence. Whether you're a beginner looking to build a strong investment portfolio or an experienced investor seeking market trends and analysis, we've got you covered. Join us as we break down complex financial concepts, explore market opportunities, and help you climb the ladder to financial success. Subscribe now and take control. When tariffs are imposed on imported goods, the immediate effect is an increase in the cost of those goods. While the products themselves remain unchanged, the additional cost, often passed from the importer to businesses and then on to consumers, can make everyday items like smartphones, electronics, clothing, and household appliances significantly more expensive. This means that, for the same products, consumers are forced to pay more. While this might sound like a small increase, the cumulative effect on the cost of living can be substantial, especially when tariffs impact a broad range of items. For example, a 10% tariff on a $1,000 product like a laptop means an additional $100 in costs that the consumer will likely absorb. For consumers already living paycheck to paycheck or those in lower income brackets, this price increase can create a real financial strain. The issue becomes even more pronounced when tariffs are applied to goods that make up a significant portion of everyday expenses, like food, clothing, or home appliances. The broader economic impact isn't just about higher prices, it also affects consumer behavior. People may be forced to cut back on discretionary spending or make sacrifices in other areas of their lives. For instance, families may hold off on purchasing big-ticket items, or they might opt for lower quality, cheaper alternatives. Over time, the overall standard of living could decrease as people struggle to afford the same goods they used to purchase regularly. This rising cost of living contributes to inflation, further eroding the purchasing power of households. Furthermore, when tariffs disrupt global supply chains, they can create uncertainty in the market, leading to increased volatility in prices and business operations. Manufacturers may also face higher production costs, leading to more widespread price hikes across various industries. As this pattern continues, it creates a ripple effect throughout the economy, leading to long-term financial strain for consumers and making it harder for businesses to plan for the future. Ultimately, tariffs may be designed to protect domestic jobs and industries, but the short-term impact on consumers, particularly those in lower income brackets, can be significant, leading to higher living costs, reduced spending power, and even less economic growth. President Donald Trump's implementation of significant tariffs has indeed sparked a broad and ongoing debate about their potential impact on the U.S. economy, particularly regarding inflation. The tariffs, which started with a 10% baseline rate on a wide range of imports from many countries, have been even more pronounced for certain nations, including China and Vietnam, two key global suppliers of consumer goods and manufacturing components. These trade policies, designed to reduce trade deficits and encourage domestic production, have raised significant concerns among economists and financial analysts, who have been closely monitoring the resulting effects on prices, economic growth, and overall financial stability. The tariffs increase the cost of imported goods, which businesses often pass on to consumers in the form of higher retail prices. As a result, inflationary pressures have been mounting, particularly on goods that heavily rely on foreign supply chains, like electronics, automobiles, and raw materials. The broader concern is that these price hikes could contribute to rising inflation across the economy, thereby eroding consumers' purchasing power. Additionally, while the tariffs are intended to protect U.S. industries from foreign competition, there are fears that they might also provoke retaliatory tariffs, which could further disrupt trade and exacerbate global economic tensions. Economists warn that this combination of higher prices, slower growth, and trade disruptions could have broader negative implications. Some fear that tariffs could lead to stagflation, a situation where economic growth stagnates while inflation continues to rise, making it more difficult for policymakers to respond effectively. As the debate continues, it has become clear that while tariffs may have short-term political appeal, their longer-term economic consequences are far from certain, and the trade-offs between domestic protectionism and global economic integration remain a key point of contention. Direct impact on consumer prices. Tariffs serve as a form of tax on imported goods, and their immediate effect is a rise in the cost of these goods for U.S. importers. Since businesses typically do not absorb this additional expense, they often pass the burden on to consumers by increasing the retail prices of affected products. This means everyday items, ranging from electronics, like smartphones and laptops, to household appliances, automobiles, and clothing, become more expensive. For example, if a laptop costs $1,000 to import, a 10% tariff would increase its cost to $1,100. That added $100 is likely to be passed on to the final price paid by the consumer. As a result, the overall cost of living increases because many essential and widely used products experience price hikes. The impact of this is especially significant for American households, which face a reduction in their purchasing power. To maintain the same standard of living, consumers must either spend more money or settle for fewer goods or lower quality alternatives. This inflationary pressure is particularly hard-hitting for low and middle-income households who already allocate a larger portion of their budgets to essential items, many of which are imported. Over time, these rising costs contribute to broader inflation, creating a financial strain on consumers and potentially reducing their ability to save or invest. The cumulative effect can diminish economic well-being for large segments of the population, especially those least able to absorb the higher costs. Broader economic implications. Beyond the immediate rise in consumer prices, tariffs can trigger broader and more complex economic consequences that affect the entire economy. According to the Organization for Economic Cooperation and Development, OECD, protectionist trade policies like tariffs tend to slow down economic growth not only within the country imposing them, in this case the United States, but also across the global economy. This is because tariffs disrupt international trade flows, increase costs for businesses that rely on global supply chains, and create uncertainty in the market. When businesses face higher costs and unpredictability, they often delay investment decisions, reduce hiring, or even scale back operations, which weakens overall economic activity. At the same time as prices rise due to increased import costs, inflationary pressures mount. The dangerous combination of sluggish growth and rising inflation can result in stagflation, a rare but harmful economic condition where economic stagnation coexists with high inflation. Stagflation is particularly challenging to address through traditional monetary or fiscal policy because efforts to curb inflation, such as raising interest rates, can further slow down growth, while attempts to stimulate growth may worsen inflation. As a result, the economy may suffer prolonged periods of low productivity, reduced consumer confidence, and lower standards of living. Estimates of inflationary impact. Multiple economic studies have sought to estimate how significantly tariffs could drive up inflation in the coming years. For instance, the Congressional Budget Office, CBO, has projected that President Trump's tariff policies could increase the Personal Consumption Expenditures, PCE index, a primary indicator used by the Federal Reserve to measure inflation, by a full percentage point by the year 2026. This may sound modest, but in economic terms, a 1-point rise in core inflation is quite substantial and can have serious ripple effects. Furthermore, research from the Peterson Institute for International Economics paints an even more concerning picture, forecasting that the inflation rate could rise to between 6% and 9.3% by 2026 if these tariffs are fully implemented. In contrast, inflation without the tariffs would likely remain around 1.9%, which is much closer to the Fed's long-term target. This dramatic increase in prices could severely erode the purchasing power of consumers, particularly affecting low and middle-income households that are already vulnerable to rising costs. Moreover, as inflation climbs, the Federal Reserve may be forced to raise interest rates more aggressively in an attempt to stabilize prices, which could slow borrowing, reduce investment, and dampen economic growth even further. This chain reaction illustrates how inflation caused by tariffs doesn't just affect prices at the checkout counter. It has the potential to influence monetary policy, credit markets, and overall economic momentum. Potential for a global recession. The imposition of these tariffs has not only stirred domestic economic worries, but has also sparked serious concerns about a looming global recession. Financial markets, which are highly sensitive to uncertainty and geopolitical tension, have reacted sharply to the escalating trade conflict. Investors fear that the rising costs and disrupted trade flows resulting from these tariffs will hurt corporate profits and reduce global demand. As a result, stock markets across the world have experienced significant losses. In the United States, the stock market recently suffered its steepest drop since the pandemic-driven crash of 2020, wiping out more than $6 trillion in market value in just a short period. These dramatic market downturns reflect widespread investor anxiety and declining confidence in future economic growth. Compounding the issue, China has retaliated with its own set of tariffs, intensifying the trade war and further destabilizing international markets. This tit-for-tat approach has deepened fears of prolonged economic stagnation. Major financial institutions, including J.P. Morgan, have revised their forecasts in response to these developments, with the bank now estimating a 60% chance of a global recession. Additionally, it predicts a 0.3% contraction in U.S. GDP in the fourth quarter of 2025, a concerning sign for the world's largest economy. A global recession would have widespread consequences, including reduced trade, higher unemployment, falling consumer confidence, and increased government debt, making economic recovery a far more difficult and prolonged process. Administration's perspective. Despite widespread concerns from economists and market analysts, key figures within the Trump administration have consistently defended the tariff strategy. Treasury Secretary Scott Bessent and White House advisor Peter Navarro argue that the tariffs are not merely punitive, but are part of a broader, strategic economic policy designed to rebalance trade relationships that have long disadvantaged the United States. According to their view, these tariffs represent a one-time recalibration of trade policy aimed at encouraging domestic manufacturing, reducing dependence on foreign imports, and ultimately fostering long-term job growth across critical industries. They maintain that although short-term disruptions and price increases are expected, the long-term result will be a stronger, more self-reliant American economy with increased employment opportunities and a healthier trade balance. However, this optimistic outlook is not widely shared among economists. Critics argue that the immediate consequences, such as rising consumer prices, decreased purchasing power, volatile financial markets, and slower economic growth, are already evident and outweigh the uncertain future benefits. Many analysts believe that rather than solving trade imbalances, tariffs may shift economic burdens onto American consumers and businesses, potentially harming the very sectors they are intended to protect. The divide between the administration's promises and expert projections highlights the complexity of trade policy and the challenges of balancing short-term sacrifices with long-term economic goals. In summary, President Trump's recent tariffs are expected to have a significant inflationary impact on the U.S. economy, affecting consumer prices, economic growth, and potentially contributing to a global recession. While the administration maintains that these measures will lead to long-term economic benefits, the immediate effects suggest increased financial strain on American households and heightened economic uncertainty. That's it for today's video. If you found this helpful, don't forget to like, subscribe, and turn on notifications so you never miss an update. At WealthEchelon, we're all about helping you navigate the world of crypto, investing, and financial growth. Have any thoughts or questions? Drop them in the comments below. I'd love to hear from you. Stay sharp, stay invested, and I'll see you in the next one.